Hi, we're calling this one Putting the Portfolio Puzzle Together. How to invest is a puzzle for many investors. Where do you start? In what should you invest? And what do you need to know? When we're talking about long-term investing, there are a few basic concepts about which you need to know. First and foremost, you must determine your risk tolerance. On any given day, the market will go up, or it'll go down, or it might move sideways. Historically, over time, we know that it has gone up. I know you're going to be happy when the market goes up, but how are you going to feel when the market goes down? How well would you sleep if your portfolio loses 10 or 20% in a year? So the first piece of puzzle that we need to put in place is knowing your risk tolerance. For the long-term investor, and I'm talking about 20 years or longer, you should be holding equities. Equities are stocks. It's an ownership in a company. Your first reaction may be, I don't have 20 years to invest. Well, statistics tell us that for a married couple, each of whom is 65, the probability that one of them will reach at least age 90 is 50%. John Bogle, the founder of Vanguard, has said that a rule of thumb for the amount of equities that should be in your portfolio is to take your age, subtract it from 100, and that is the percentage in your portfolio that should be invested in equities. So the second piece of the puzzle is owning equities. The third piece of the portfolio puzzle is to diversify. To diversify means owning equities worldwide and owning bonds worldwide. Further, it means not owning the same segment of the market. For example, all financial stocks or all manufacturing stocks. On the bond side, we want short-term bonds and we want longer-term bonds. We want government bonds and we want corporate bonds. And again, we want bonds worldwide. Bonds have a tendency to reduce the volatility in a portfolio. The fourth piece of the puzzle is to rebalance the portfolio. For example, if your risk tolerance causes you to invest 60% equities and 40% bonds, after a period of time, your portfolio is 65% equities and 35% bonds, you would sell 5% of the equities and buy 5% of bonds. So you would get back to your original mix of 60-40. Research by Eugene Fama, finance professor at the Graduate School of Business at the University of Chicago, and Kenneth French, professor of finance at the Tuck School at Dartmouth College, suggests that by adding equities, small cap stocks, and stocks with a high book value to price ratio, customarily called value stocks, you receive a risk premium return, and this is called the three-factor model, and it is the fifth piece of the puzzle. The sixth, seventh, and eighth pieces of the puzzle are what not to do with your portfolio. Puzzle piece number 6, don't pick individual stocks. Puzzle piece number 7, don't try to time the market. And puzzle piece number 8, no track record investing. Don't select investments based on someone's track record. I cover why these 3 don'ts are killers to your portfolio on my website, billmullen.org. To base a choice on how well someone has done in the past is track record investing. Remember, past performance is no guarantee of future results. In addition, Morningstar reports that the average equity portfolio has a turnover ratio of 100%. What that means is that the stocks that the manager held on January 1st are not the stocks that he is holding on December 31st. That means that the manager is picking stocks and timing the market. Does it make any sense to use any of these methods to construct your portfolio? I don't think so. So let's take a look at what our puzzle looks like with the 8 pieces we have discussed. It's evident that our puzzle is not complete. Don't you just hate it when you think you're finished and there's one piece missing? Well, here's the 9th piece. You need to hire a coach. So here's why you need to hire a coach. First, you're going to have a very tough time adding the 3-factor model on your own. Second, probability is very high that you're going to let your emotions get in the way and want to ride your winners and not rebalance the portfolio. And when the market is tanking, you need a coach to remind you of why you selected the portfolio you selected. And when the market is soaring, you're going to need a coach to remind you of why you selected the portfolio you selected. So here's the completed puzzle. Just remember, if you know the right things, you don't need to know everything. And here's my wish for you. Blue skies, green lights, and happy returns.